Welcome, curious minds. Today we're taking a deep dive into a really fascinating stack of market sources. We've got pretty much everything from U.S. and global market recaps to, detailed analyses of individual stock movers and some crucial upcoming economic events. Our mission today is to quickly dig into today's stock market close, pull out the most important insights, kind of decode the forces behind those big moves, and give you a crystal clear picture of what's on deck for tomorrow. Think of it as your shortcut to being, truly well-informed about the day's financial landscape.
Yeah, and what's really fascinating here is how interconnected all the market signals seem to be today. We're going to try and connect the dots between, broad geopolitical shifts, that central bank speculation that's been rippling through the markets, and even the performance of individual companies, hopefully helping you understand not just what happened in the closing hours, but maybe more importantly, why it matters for your own perspective and strategy.
Okay, diving right in then. Let's zoom out to the broader U.S. market picture first. What did the domestic markets tell us today?
The S&P 500, which we often see as like the heartbeat of the market, right? A bellwether. It closed remarkably strong. It was up approximately 0.8%, ending the day around $611.87. And this put the S&P within mere points, I think it was just 3 points, of hitting a brand new all-time record high. That's quite a rebound.
It really is. That nearly record close for the S&P 500 speaks volumes, I think.
Yeah.
And it wasn't alone. The tech-heavy NASDAQ composite also saw significant action, advancing a full 1%. That brought it to its highest closing level since mid-December, showing just how sustained the strength in tech has been. And you can't forget the Dow Jones Industrial Average, right? The venerable Dow. It wasn't left behind either. Climbed a solid more 0.9%, gaining around 404 points to end the day at 43,386.84. So yeah, really robust gains across the board, reflecting some pretty widespread positive sentiment out there.
It definitely sounds like a broad-based rally then. But what about smaller companies? Sometimes they tell a different story or maybe confirm the trend. Are they participating?
Yeah, good question. And if we connect this to the bigger picture, that widespread strength is definitely noteworthy. Even the Russell 2000, which tracks those smaller, more domestically focused companies, often seen as a barometer for broader economic health and risk appetite, it saw a robust 1.7% gain today. So this suggests the rally isn't just, confined to a few dominant mega cap stocks. There's much broader participation across different market segments. And that's generally seen as a sign of healthy, maybe more sustainable market sentiment. It also tells us just how quickly market fear can subside. I mean, remember April?
Oh, yeah.
When the VIX, the fear gauge, was up above 50?
Way up there.
Today, it's down dramatically. It's sitting comfortably in the mid-teens. That signals a huge reduction in investor anxiety, a return to more stable trading. It's like a collective sigh of relief.
Right, a collective sigh of relief. So a truly strong day for U.S. markets. But did that enthusiasm travel? Did it ripple across the globe? Were international markets singing the same tune, or were there, regional differences we should be aware of?
Oh, absolutely. The enthusiasm spread. Global equities broadly joined the rally. In fact, they closed at fresh record highs for the third consecutive day. That kind of sustained global upward momentum is quite significant. It points to a synchronized positive shift in investor sentiment worldwide. European equities, they edged higher by about 0.1%. And MSCI's global index, which tracks performance across developed and emerging markets, that rose around 0.8%, hitting multi-session highs. We saw particularly strong rallies in emerging markets too. India's Sensex, for example, jumped approximately 1,000 points. That surge in India seems to be benefiting from a few things: the weaker dollar, easing geopolitical tensions that affect global capital flows, and maybe that recent slight dip in oil prices, which is obviously a major import cost for India. The one area that lagged a bit, though, was UK retailers.
Ah, okay.
Which just highlights how local conditions, specific consumer spending patterns or domestic economic pressures can sometimes diverge from the bigger global trend. It shows the nuances of international markets.
Okay, that's a truly impressive slate of gains, both domestically and globally. But for listeners trying to connect the dots here, what really fueled this broad market rally today? Was it just one big thing, or was it a mix? A kind of perfect storm of positive factors?
It was definitely a convergence, I'd say. The sources we looked at highlight 4 key drivers that really seem to come together today to create this widespread market strength. First, and maybe the most prominent, is that unrelenting tech-driven momentum. This has been the story for much of the year, right? And today was no different. It's still acting as a powerful engine for the whole market.
And leading that charge, well, no surprise here, it's NVIDIA, gained another 0.5% today, reaffirming its position as the world's most valuable U.S. company. It's now valued at, an astounding $3.78 trillion. This AI chip euphoria just seems to be the core engine. Tech stocks overall have surged. I saw figures like 32% to 40% just from their April lows. That's massively outpacing the broader S&P 500. But the real insight here maybe is the sheer concentration of power and capital flow we're seeing. It's not just general tech growth. It feels like a profound, almost singular bet on the future of AI, with NVIDIA leading the pack. And this concentration, it raises questions for investors, right? Like, is this a healthy, broad rally, or are we maybe seeing a potential AI bubble forming? Kind of like past tech booms where a few giants pull everything up. Understanding that dynamic helps you gauge the market's real health and maybe spot potential risks.
Yeah, and what's fascinating too is how that AI enthusiasm spills over beyond just the giants. Take Palantir, for instance, the data analytics company. It hit record highs today, up 0.9%. It's up an incredible 91% year to date.
And that surge seems directly tied to its growing use of AI within its platforms. It shows how companies actually leveraging AI in practical revenue-generating ways are getting rewarded. Then there's Core Scientific. They provide digital infrastructure, crucial for high-performance computing, jumped a massive 33% today.
33%.
Yeah, huge move. And that was directly following renewed acquisition talks with CoreWeave, which is a specialized cloud provider for AI workloads. So this isn't just about individual stocks moving. It really underscores this broader trend of strategic consolidation and big investment in the AI and cloud infrastructure space. Companies are jockeying for position, basically. That M&A activity itself signals strong underlying thematic strength and a pretty aggressive positioning for future growth in AI.
Speaking of individual movers, Micron Technology. That presents a really interesting case today. Despite beating its fiscal Q3 estimates, revenue was up 37% to $9.3 billion. Their high bandwidth memory, HBM, revenue surged nearly 50% sequentially. And they projected strong Q4 revenue, too, between $10.4 and $11 billion. Despite all that, the stock actually edged down around 1%. That seems incredibly counterintuitive.
Right.
Why would a stock dip on what looks like overwhelmingly positive news?
It's often that classic buy the rumor, sell the news scenario, isn't it?
Right.
It means investors often push the stock higher before the official announcement, just based on anticipation. Then, once the actual good news hits, some take profits because that positive outcome was already fully priced in, as they say. In Micron's case, expectations were just astronomically high, especially around those HBM chips, the high bandwidth memory. Those are super important for AI, right? They process massive amounts of data incredibly fast.
For crucial components.
Exactly. So expectations were sky high, and maybe even fantastic numbers weren't quite enough to push it further today. So you see that slight dip as traders lock in gains. But despite the dip, analysts are still overwhelmingly bullish on Micron. Like, 85% rated a buy, price targets are as high as $165.
So the long-term picture is still strong.
It suggests the long-term fundamentals remain exceptionally strong, yeah. Especially with that insatiable demand for HBM chips as AI keeps spreading. It's just a powerful reminder that market reactions can be complex, even to good news. Often reflects short-term trading dynamics more than a fundamental shift.
We also saw pretty significant movement in the crypto space today. Coinbase was up 5.5%, hit its highest close since way back in November 2021. It's up something like 54% just in June. That's a huge jump. What was behind that?
Yeah, that move was directly tied to some significant regulatory tailwinds. Specifically, the Senate approval of the Genius Act. This legislation is really crucial because it provides much-needed legal and operational clarity for stablecoins.
Stablecoins.
Yeah, exactly. Those are the digital currencies designed to hold a stable value, usually pegged to the US dollar. They're essential for making transactions smoother and reducing volatility in the crypto world. This kind of regulatory certainty is exactly what the crypto market has been craving. It reduces ambiguity, creates a more stable framework for institutional growth, for wider adoption. So for a sector that's been so heavily influenced by regulatory uncertainty, getting this clarity can really spark these multi-month rallies like we saw with Coinbase. It gives businesses a clearer path forward.
Okay, so beyond tech and crypto regulations, another crucial driver you mentioned was geopolitical relief. It sounds like global anxiety levels maybe took a noticeable step back today.
Indeed. A really significant factor was that ceasefire reported between Israel and Iran. Now, this wasn't just a headline. It immediately dampened those earlier Middle East jitters that had been a persistent source of anxiety for markets. You saw it contribute directly to a noticeable dip in oil prices, and it supported a pretty pronounced risk-on positioning in global assets.
So people moving back into stocks.
Exactly. It highlights how sensitive markets are to geopolitical stability. When the perceived risk of a wider conflict goes down, investors quickly move from safer havens like gold or certain government bonds back into higher-yielding assets like equities. We also saw some easing of those rare earth tensions between the U.S. and China, with an agreement reported on expediting shipments.
That's important for supply chains.
Fundamentally important, especially for critical technologies reliant on those rare earths. It helps reduce potential trade friction that's plagued markets for years now. So this broader de-escalation contributed significantly to today's positive sentiment, letting investors focus more on growth stories instead of immediate threats.
Okay, and the third major factor you mentioned was Fed speculation and a weaker dollar. This one's always fascinating because it gets into the nitty-gritty of central bank policy, which can just have such profound effects on everything.
It really does. In this situation, it brings up some important questions about the independence, maybe the future direction, of the central bank. There were reports that former President Trump might appoint a new Fed chair before May 2026. That, combined with two Trump-appointed Fed members hinting at a possible July rate cut, well, that weighed heavily on the dollar.
The political angle influencing Fed expectations.
Exactly. This speculation about a potentially more dovish Fed chair, meaning someone likely to favor lower interest rates, and just the whispers of immediate rate cuts significantly shifted market expectations. The U.S. dollar index, which measures the dollar against a basket of major currencies, dropped about 0.43% today. And get this, it's now down over 10% year to date. That's its steepest first-half drop since the early 1970s.
Wow, since the 70s, that's historic.
It really underscores the significance of this move. Such a rapid decline hasn't been seen in decades. It reflects a pretty profound shift in global confidence, maybe, or at least perception, about the dollar's strength and the future path of U.S. monetary policy.
So what's the tangible impact for the average investor when the dollar weakens like that?
Yeah.
And why are markets so sensitive to even whispers of a potential rate cut?
Well, connecting this to the bigger picture, a weaker dollar typically gives a boost to risk assets like stocks and also commodities like gold. It works in a few ways. Primarily, it makes U.S. exports cheaper for foreign buyers, which can significantly boost earnings for U.S. companies with big overseas operations.
Right, makes their stuff more competitive.
Exactly. And it also increases the value of those overseas earnings when they're converted back into a weaker dollar. Plus, it makes dollar-denominated assets like gold or oil more attractive and less expensive for international investors, which can drive up demand and prices for those too. Now, markets are pricing in about a 25% chance of a July rate cut. That's a big jump from only 12.5% just a week ago.
That's a fast shift in expectations.
Very fast. And this rapid shift also drove Treasury yields lower. The 10-year yield hit around 4.25%, its lowest in 7 weeks. The 2-year yield dropped to 3.72%, lowest since May 2nd. And lower yields generally make equities look more attractive compared to bonds because that fixed income alternative is just less compelling. That contributes to the broader stock market rally as investors chase higher returns.
Okay, and finally, the fourth driver. Some strong earnings beats. This shows it wasn't just about macro factors or a few big tech names, but actual underlying corporate health seemed pretty good too.
Yes, and this is a crucial point, I think. Several companies delivered positive surprises that really helped buoy specific sectors and the overall market. McCormick, the spice company, jumped 5.3% after topping expectations, showed some unexpected resilience in consumer spending. Acuity Brands, they do lighting solutions, up 5.8%. That signals maybe some strength in commercial construction, infrastructure spending. H.B. Fuller, global adhesives maker, surged an impressive 11% after upbeat results and a stronger outlook. Points to pretty robust industrial demand.
11% is a big move.
It's a huge move. And Worthington Steel climbed a massive 20% after beating its Q4 expectations, indicating a healthy manufacturing sector. Even Shell, the energy giant, rallied over 2% after dismissing some acquisition rumors. Added stability to the energy sector, maybe reflected some renewed confidence in its fundamentals. So this breadth of strong earnings across various sectors, consumer goods, industrials, energy, even financials, with J.P. Morgan hitting that $800 billion market cap, not just tech, that's a really healthy sign. It suggests the market strength is broadening out, which adds to overall stability and investor confidence beyond just the immediate AI hype. It points to maybe a more robust economic foundation than a rally solely driven by speculative tech.
Okay, so that was today. What does this all mean for tomorrow then? What should we be keeping a close eye on as the trading day approaches? The market rarely sits still, right? There are always new catalysts coming.
Absolutely. Tomorrow, Friday, June 27th, has a few key catalysts you'll definitely want to watch. First up, on the earnings front, we've got Apogee Enterprises, APOG. They're known for architectural products like windows and glass. They report Q2 earnings before the market opens. Estimates are around $0.50 per share. Now, while it's not a huge market-moving giant, its results can offer some insights into the health of construction and commercial real estate sectors. Those are important bellwethers for the broader economy.
Right. Good context there. And perhaps even more widely anticipated is Nike, NKE. They report Q4 earnings after the market closes tonight. The sources suggest watching very keenly for any turnaround signals there. Given the competition in athletic wear, changing consumer trends, its performance and especially its forward-looking statements could certainly set the tone for a lot of retail-related names tomorrow, maybe influence the whole consumer discretionary sector.
Definitely one to watch. Then, on the economic calendar, we have a couple of important data releases tomorrow morning. At 8:30 a.m. Eastern Time, we get the personal income and spending data for May. Now, while its market impact can sometimes be a bit muted in isolation, it's absolutely crucial for understanding consumer health. And as we know, consumer health is the major driver of the U.S. economy, right? Accounts for roughly 2/3 of all economic activity.
Backbone, yeah.
Exactly. So this data gives vital insights into how much consumers are earning and, more importantly, how much they're choosing to spend. That directly translates into economic growth or contraction. Investors will be looking for signs of sustained spending power, especially with inflation still around.
Okay, and then at 10:00 a.m. Eastern, we'll see the final U.S. consumer sentiment reading for June. The estimate was around 60.5, I believe. How significant is this one, and what should listeners look for to gauge its potential impact?
Well, this really gets to the question, does consumer confidence remain resilient? In the face of ongoing inflation, economic shifts. Or are we starting to see cracks appear in consumer optimism? This reading, it comes from the University of Michigan survey. It can really influence overall market sentiment and perceptions of economic strength. Confident consumers are just more likely to make big purchases, to invest, driving economic activity.
Makes sense.
So a significantly lower than expected reading could signal a pullback in discretionary spending, which wouldn't be great. And crucially, at 11:30 a.m. Eastern, Fed's John Williams is scheduled to speak.
A Fed speaker, always important.
Always. His tone, any comments on the path of interest rates, the inflation outlook, the strength of the economy, that could definitely shift Fed expectations, potentially impacting Treasury yields and the dollar pretty quickly. His remarks will be parsed very carefully for any hint of future monetary policy moves. So that speech is a prime watch point for immediate market reactions tomorrow.
Got it. So beyond those specific times and scheduled events, what broader watch points should we have on our radar? Maybe for the coming days and weeks. The sort of underlying currents that could steer the market.
Yeah, a critical one is the PCE inflation report. That's also expected Friday, though the exact time can sometimes vary a bit. This is the Personal Consumption Expenditures Price Index, and it's the Federal Reserve's preferred gauge of inflation.
The one they really watch.
The one they really watch for their policy decisions. So its tone, whether it shows inflation cooling down or staying stubbornly sticky, that will heavily guide next week's bond and yield movements, and by extension, overall market sentiment about future rate cuts. If PCE comes in hot, it could push back those rate cut expectations again. Also, keep a very close eye on that July 9 Liberation Day tariff pause expiration.
Right, the U.S.-China tensions.
Exactly. Any flare-up in U.S.-China tensions around that date, especially concerning trade tariffs or maybe access to critical rare earths again, that could quickly alter market direction, inject significant volatility and uncertainty. And of course, just the ongoing Fed uncertainty regarding that potential early replacement for Chair Powell. That continues to introduce policy credibility questions and could lead to more market speculation, directly influencing the dollar and treasury markets. So these are all critical variables that could significantly influence market behavior beyond just tomorrow's scheduled releases.
Okay, now let's pivot to the practical side. With all these moving parts, we've got earnings, economic data, Fed talk, geopolitics.
Yeah.
How can you, our listener, think about strategizing for tomorrow's market? What's the sort of overarching game plan?
Well, I think the overarching strategy, based on the sources, should probably be to stay positioned for that rate cut optimism, especially in rate-sensitive sectors like technology, financials, maybe gold. The market is clearly leaning towards an easier monetary policy environment right now, anticipating lower borrowing costs. However, and this is a big however, you absolutely must remain vigilant, meticulously monitoring those key macro events, the July 9th tariff deadline, any further Fed commentary, especially from John Williams tomorrow, and any shifts in geopolitical developments. The market narrative can shift incredibly rapidly. What looks like a clear path today could be quickly altered by new information tomorrow.
Right. So given this backdrop of optimism mixed with that potential volatility, how do we protect ourselves against unexpected shifts or maybe a sudden reversal in market sentiment? What kind of defensive moves can listeners think about?
Yeah, that really brings us to the crucial question of how to manage risk effectively in this kind of dynamic environment. The sources suggest adopting defensive overlays, things like equity puts or maybe volatility plays to hedge against sudden reversals, especially in what are becoming, crowded trades like big tech and gold.
Crowded trades meaning lots of people are in them.
Exactly, where a large number of investors are all taking the same side. That makes them vulnerable to sharp pullbacks if sentiment shifts, because everyone tries to get out the door at once. Equity puts give you the right to sell a stock at a certain price, protecting your downside. Volatility plays, like buying VIX ETFs, can potentially profit if market fear spikes. Also, using tight stop losses, maybe setting them 2-3% below your entry price, is really key given the potential volatility from tomorrow's earnings and that Fed talk. The goal here is just to limit your downside exposure if the market moves against your position. Helps preserve your capital.
Okay, let's get even more granular then. What would a potential game plan look like for, say, the first trading hour tomorrow? Depending on how the market opens, can we break it down by scenario?
Sure, let's try. Scenario 1. If futures gap up significantly, let's say 0.7% or more, that indicates strong pre-market momentum, continued bullish sentiment. In that case, you'd look for continued upside. Specifically, you might consider an NVIDIA momentum scalp.
A scalp trade, meaning quick in and out.
Exactly, a very short-term trade. Looking to go long only if the price clearly breaks above today's record high on strong volume, and you'd trail a tight stop loss, maybe 1.5% below your entry. That AI chip euphoria, it remains a powerful intraday liquidity magnet. Breakouts on strong volume can be very robust, but it's high risk, high reward. Now, the flip side, if NVIDIA gaps up, say, over 1%, but then fails to hold its VWAP, that's the volume-weighted average price.
The average price weighted by volume.
Right. If it fails to hold that level, you might actually consider a short fade strategy. Betting on that initial surge fading, anticipating a reversal, you'd use a strict plus 1% hard stop on that kind of trade because those reversals can be sharp.
Okay, scenario 2. What if the market opens relatively flat? Maybe just a minor plus or minus 0.2% change. What's the playbook then?
Right. If we open flat, you'd really want to gauge how the market is digesting two key things. The Nike earnings reported tonight and that personal income spending data released at 8:30 a.m. Eastern. This might be a time to look at specific news-driven plays. For example, Core Scientific, CORC, given that massive 33% pop today on the CoreWeave takeover talk renewal, the headline algorithms are going to keep that stock jumpy and volatile tomorrow.
Very sensitive to news.
Extremely. So you might look to buy the first consolidation pattern above its opening range, but only if volume is strong, indicating continued buying interest. You'd risk maybe 4 to 5 cents per share on that trade, keep it tight. This type of play needs quick reactions, close monitoring of news flow. These stocks can move dramatically on any related headlines. Another approach on a flat open might be just watching how consumer discretionary stocks react overall to Nike's outlook, potentially identifying a broader sector trade based on that.
Makes sense. And scenario 3. What if we see a gap down, say more than 0.5%, indicating some negative sentiment overnight or maybe a shift in the broader economic outlook? How should we approach that?
Yeah, in that gap down scenario, you definitely want to be monitoring U.S. Treasury futures and the dollar index very closely for any significant shifts. A gap down might be triggered by, say, unexpectedly hawkish comments from Fed Speaker John Williams, or maybe weaker than expected PCE inflation data that really dampens those rate cut hopes. You'd also want to be ready to potentially shift into more defensive or cyclical themes if the macro data really disappoints. Investors might rotate out of growth stocks and into sectors considered safer, like utilities or consumer staples. For NVIDIA specifically, if it gaps down significantly or if it opens flat but then quickly drops below its VWAP, you might consider that short fade we discussed earlier, but maybe with an even stricter stop because those downside reversals can be really sharp and quick. The key in a gap down is just to be adaptable. Don't force a trade if the market isn't confirming your initial bias. This scenario demands more caution, focus on capital preservation.
Okay, that's helpful for the immediate open. But beyond the day trading opportunities, the sources also offered some interesting ideas for medium and long-term investors, right? Providing some templates you could adapt for different time horizons. What were some of those strategies?
Yeah, definitely. For the medium term, one idea was a bullish swing trade in Micron, MU. It's strong guidance, really driven by that unprecedented demand for HBM chips for AI. It's incredibly compelling, fundamentally. The suggestion was you could scale in, meaning buy in smaller increments, maybe near 5% pullbacks towards its 21-day exponential moving average, aiming for those analyst targets around $160, $165, which is about 15% upside from recent levels. You'd set a stop, maybe cut the position if it closes decisively below its 50-day moving average, signaling a break in the uptrend. Also, a pretty compelling pair trade idea came up. Go long SOXX, that's the semiconductor ETF, versus short UUP, the dollar index ETF.
Interesting combo. What's the thesis?
The thesis is basically to benefit from two trends at once. The ongoing AI chip upside, which SOXX captures, combined with that continued dollar weakness we talked about, which shorting UUP allows you to bet against. The idea was to set up roughly 50-50 notional exposure between the two, review it weekly to keep it balanced, and maybe unwind the trade if the 10-year Treasury yield climbs back above 4.6%, as that might signal a stronger dollar or a less favorable environment for semis. The goal was seeking maybe 8-10% relative outperformance over the summer. Now, for longer-term investors, accumulating JPM, seemed to make a lot of sense based on the sources. It just crossed that $800 billion market cap mark, solidifying its position as a financial behemoth. And with potentially easier Fed policy coming lower interest rates, it's thought to be poised to gain market share, maybe as some smaller fintechs struggle or retrench. Higher net interest margins could also help, plus aggressive share buybacks. So the strategy suggested was dollar cost averaging on any 5% or more market pullbacks, investing a fixed amount regularly, and just reinvesting the dividends. A solid, low-maintenance approach.
And you'd only reconsider if the Fed suddenly got much more hawkish.
Right. The note was you'd reevaluate if the Fed signaled, say, more than 100 basis points of additional hikes, which seems like a pretty low probability scenario right now. And finally, a strategic gold allocation, maybe through an ETF like GLD or even physical gold. Gold benefits significantly from dollar weakness and also acts as that classic geopolitical shock absorber. It serves a dual role: crisis hedge during uncertainty, and store value against inflation, especially when the dollar is weakening. Suggestion was maybe start with a 25% allocation within your hedge bucket, add on dips towards its 50-day moving average, holding it as a long-term hedge. You'd maybe consider reducing if real yields climb above 2% and the dollar index decisively clears 110, as those conditions tend to be headwinds for gold.
Got it. And just quickly, a risk checklist to keep in mind. Regardless of the strategy, something to always remember before hitting that buy or sell button.
Absolutely. Always remember to size your positions appropriately. The suggestion was less than 2% of your liquid capital for day trades, maybe less than 5% for swing or longer-term plays. This is just crucial for managing overall portfolio risk, ensuring no single trade can cause catastrophic damage, and always set hard stop losses before you even enter a trade. Especially with those high beta names, the more volatile stocks or anything highly sensitive to news like Core Scientific, or stocks influenced by policy headlines in foreign exchange or semiconductors. News can create immediate, sharp gaps in price, leaving you really vulnerable if you don't have that stop in place. Basically, trade smart, manage your downside first, and always adjust these general blueprints to fit your own unique playbook and your personal risk tolerance.
Wow, what a comprehensive deep dive into today's market action. We've really seen how that tech momentum, the shifting Fed narrative, maybe some global geopolitical calm, how they're all intricately linked, shaping the landscape. The market's ability to absorb these sometimes conflicting signals and still push towards new highs is truly remarkable. It reflects a really complex interplay of factors that demands close attention from all of us.
It really does. And this raises, I think, an important question for you, the listener. Considering all these interconnected factors we've discussed, from the surge in AI-driven tech and the, nuanced impact of Fed speculation to the calming effect of ceasefires and those surprising earnings beats across diverse sectors, what stands out most to you as the biggest driving force shaping the market right now? And maybe more importantly, how might you integrate these insights into your own understanding and your future investment decisions?
Yeah, something to definitely think about. We hope this deep dive has given you some valuable nuggets of knowledge today, maybe some new ways to think about the financial world. Keep exploring, stay curious, and continue digging into the stories the data tells us.
When the markets go wild, most people panic. But the smart ones, they tune in. From gold to AI, from fear to focus. TradeWinds Radio, your edge in the market storm.